Welcome to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk.
I'm Greg Friedman, CEO of Peachtree Group, and this is another episode of Peachtree's Point of View podcast. And we're fortunate today because we have Michael Parise, who's joining the show, and I'll let Michael give his background. But today we're really going to focus on tax efficiency. As many know, to grow net worth, grow asset values, if you can be very tax efficient in how you invest capital, it's a great way to really accelerate your net worth. With that, I'll turn it over to Michael to just introduce yourself, tell us a little bit about your background, because I know you're an expert as it relates to tax efficiency on the investment side.
Hey, Greg, thanks for having me on the podcast today. And as mentioned, my name is Michael Parise. I am the attorney on staff and chief compliance officer of Beech Financial Group. We are a multifamily office platform. We represent about 45 high net worth, ultra high net worth individuals and families and privately held business owners across the country. And we act as really a family CFO for them. We do all manner of high sophisticated planning for them generationally. And one of the big things that we talk about is tax efficiency, or very much of the opinion that's not what you make, it's what you keep. And so a lot of our planning and our advice is really based on that concept. And I think we're going to get into a little bit of that today.
That's great. So you represent 45 families and you're constantly helping them just optimize their investments so that they can really accelerate the growth of those investments and be as efficient as possible. What is one program that you're really focused on? Can you maybe talk about one that you find to be extremely accretive to high net worth individuals and family offices?
Sure. I think that one of the areas that we really focus a lot on, as I mentioned, it's not what you make, it's what you keep. But particularly in the investment side of the world, we're really looking at really what your net composite rate of return is. That's a term that we use a lot. And really what that means is what's your return that you get on your investment minus any fees that you had to pay in order to get that return, taxes, and inflation. Now, inflation is not something you and I can really control, Greg, but we can control the tax efficiencies. An area I think we're going to talk about today a little bit is more of a custom designed life insurance structure, often referred to as private placement life insurance. And it's a way that a lot of our families that are maybe over the threshold of when they could utilize a qualified plan, things like IRAs, or Roth IRAs, 401k plans, where they want to manage assets on a more tax efficient basis. So I think that's what we're going to talk a little bit about today.
So let's talk about private placement life insurance, PPLI. I hear a lot of people typically say PPLI, which is private placement life insurance. How does it work? Walk us through that component, because it's something I've heard a lot about through the years. We have a lot of clients that have utilized it in the past on our side, and I know they're super happy with it, but it'd be great for people listening to understand better what it is.
Sure. So as I mentioned, there's certain buckets I like to refer to as where you can invest assets on a more tax efficient basis or tax favored basis. And the most common one that people are familiar with are those qualified plans, things like IRAs or Roth IRAs. But one of the areas and buckets that is often overlooked is the cash value of a permanent life insurance contract. And so that's what really at its heart, private placement life insurance is. Now, this is not going to be your traditional type of life insurance that probably your listeners are most familiar with. What we're looking at here in the private placement world is more of a variable structure. So most of your investors are probably familiar with are things like whole life insurance or indexed universal life insurance. Those are forms of permanent life insurance that any retail investor can go to, the hundreds of insurance companies that issue those products and get a permanent life insurance product that does that. A variable product is a little different. A variable product, which is available on the retail side, is something that really typically you would invest into mutual funds, in essence, within that life insurance contract. And usually the insurance company gives you a menu of funds that you can pick from in order to do that. And they're oftentimes overpriced. Again, you're limited with what sort of options that you have here. The private placement life insurance world, or the custom design life insurance world, is a variable product, but you have far more investment flexibility within that chassis. So this is a wholesale institutional type of product. It's only available to accredited investors or qualified purchasers. And within that, again, you can invest into a lot of different asset classes, things like alternatives, private equity, private credit, venture capital, hedge funds, real estate can be an asset class that can be invested into within the structure. So it's typically, again, more for that institutional quality investor that wants to have a more tax efficient wrapper around their investments. Because if for those of you that are not familiar with how permanent life insurance is taxed, I like to make the analogy it's very similar to a Roth IRA in its tax form. It's not a Roth IRA, but it operates very similar from a tax perspective. So the assets that you invest into that permanent life insurance contract, and this is any permanent life insurance contract, but now we're going to focus more on the private placement world today. But the assets that you invest into that structure grow entirely free of income tax. You can withdraw those funds free of income tax, either through withdrawals of basis or low interest tax-free loans. And then when the insured of that policy passes away, the death benefit is also income tax-free as well. So it's a tax-efficient asset that you can look to, that families look to really generationally manage assets, again, on a very tax-favored basis. So hopefully that answered your question, Greg. Happy to get into more
So
details.
basically, you could invest, like if you're investing in private credit, you're investing in hedge funds, other investments that tend to be less tax efficient, you could technically invest it in this PPLI structure and your money's compounding until you actually start withdrawing the funds. Am I understanding it correctly? Sort of like an IRA?
That's correct.
Okay.
That's correct.
And then what happens, because one thing interesting you just brought up, upon death. So if unfortunately you pass away, does it then go to the beneficiaries tax-free?
That's correct. One of the planning tools that we utilize a lot with our families are irrevocable trusts to really be the owner of this type of policy. And one of the downsides of a trust, if you're going an irrevocable trust, if you're going to invest assets within that structure, is that the income tax rates are very high within that structure. So the highest bracket threshold you hit is, I think, probably these days around $13,000 to $15,000 of income. So it's very tax inefficient. But again, you can utilize these private placement life insurance structures in order to invest assets within that irrevocable trust. But the other benefit too in that structure is that the assets can be owned outside of your taxable estate. All right. So again, contrast that with a Roth IRA or other qualified plan, where in that structure, you have to own those as individuals. So if you're somebody that is subjected to either the federal or state estate tax, depending on where you reside, having assets owned inside of a irrevocable trust will be a benefit to you. And again, you can't utilize that within IRA. But to answer your question more direct, Greg, yes, the death benefit of a life insurance contract that is compliant is income tax free.
That's great, because you're really getting that compounding effect, which is huge to accelerating your net worth and growth over the long haul. But then, especially for your family as well, as you think about estate planning and things like that, what is the best way, or could you share some examples how some of your clients have actually done this? And is it pretty simple, or is it a pretty in-depth process? Could you give a little bit more color around, how someone could actually do this and examples of it?
Sure. I think for our investors, a lot of our clients that have looked at this structure, they're really looking at it from more of an asset location perspective. So I think you're probably familiar with that term, Greg. And they want to take tax inefficient assets and they want to invest those assets in, again, a bucket or a place where they're going to get some additional tax favorability. So I think alternative investments are usually where our clients are looking to utilize this structure, is because of the tax efficiencies that we talked about a little earlier. That's usually sort of phase one. So there's a lot of planning that goes into this process to be able to determine to utilize this product. Now, it is life insurance, so there does need to be somebody that is underwritten as a part of this process. And that could be either, let's say, the investor themselves, or we have had some clients that have utilized children or even grandchildren, depending on the family's makeup, that can actually be the insured. So if you look at that from a generational perspective, and again, with our families, we often say we try to create 100-year families. So we really think generationally when we're going through this planning. So think about that from a perspective of having maybe a grandchild as the insured on this structure, where now you can have, let's say, depending on their age, sometimes 80, 90 years of growth on a tax favored basis that again can generate additional after-tax returns for a family long-term.
What's the minimum amount that someone, if they're going to utilize the structure, what's the minimum amount that they should invest into this type of structure? Or does doesn't matter?
Usually, I think it makes the most sense at around $2 million of committed capital. Now, you don't have to invest all that at once. You can spread that out over, let's say, 4 years. So maybe do 500,000 a year of an investment for 4 years. But usually 2 million is where it really, I think, makes the most sense. And again, this product type is for accredited investors and qualified purchasers only. There are more retail programs where you can have a lower minimum, but to really have the full panoply of benefits, really 2 million of committed capital is probably the minimum I would use.
And what's the cost to set up the structure?
Yeah, the costs will vary. Again, it isn't life insurance, and so the age or the health rating of whoever that insured is will have an impact on the overall cost of the structure. But generally speaking, and this is interesting, maybe a little bit of a wrinkle or let's say difference in what maybe your listeners are thinking about life insurance. This is not really the traditional life insurance world, as I hope I'm relaying. This is not where you're going to try to invest the least amount of money to get the most amount of death benefit. We call that death benefit focused insurance coverage. This is more investment focused coverage. So we want to actually try to purchase the minimum amount of death benefit that we can under the law. Now, there is laws that outline how you have to do that, but we want to try to buy the minimum amount of death benefit that we can to take advantage of the tax efficiency that comes along with that structure. So we're going to try to do that on a minimum basis, but there is that death benefit that you have to have in order to make the structure work. But usually long term, when you look at this structure, it's around a point. That's usually the benchmark that I will give to a client. So in sort of simple math calculation, quantitative purposes, if the tax savings that you're going to have on whatever assets that can be invested in that structure are greater than the cost to run the policy, it's a win.
So if you're investing $2 million, you're looking at spending about 1%. And I'm assuming that's on an annual basis, about 20,000
Correct.
a year to maintain the structure. And if you're investing in private credit, most private credit should be generating 12 to 14%, net return, you would think. So if you're using private credit, you got to pay ordinary tax rates. So effectively, normally you would be paying about 40%, I guess, 35, 40% would be taxes on that 12% on this. Let's assume it's a 12% return. You're paying 35 to 40% of that in taxes for federal tax and potentially state income tax. And so that's going to be roughly on 12%. That's 240,000 a year of distributions. And you're taking 40,000 of that. I'm just doing the math in my head really quickly. It's like 96,000 a year. So you're effectively netting, if I'm doing this correct, and correct me if I'm wrong, Michael, but you're basically netting 76,000 a year of additional income that you're able to go reinvest, if I'm doing the math super quick correctly.
Yeah, exactly. Yeah, exactly right. I think you're right on with that. I think, again, if you look at the highest income tax rates on the ordinary income tax side, right now it's at 37% federal. Depending on what state you live in, it could be 10. For California, it could be up to 13%. So if you do the math on that, it's used, let's say, a 10% pre-tax rate of return or yield on that really just right off the bat could get dropped down to 5 or 6, right? So I think it's, to your point, Greg, it's important to really put that into perspective where, of course, there's going to be costs associated with running the policy, but if you compound that over long periods of time, that's really where you can generate a lot of after-tax alpha or after-tax return on the strategy.
That's incredible. What's the downside to investing in PPLI? I mean, from my perspective, it seems like it's something that everyone, especially everyone that has, 2 million or more of investable assets across private credit and hedge funds, should be looking at this structure. But is there something I'm missing besides just having the investable dollars?
I think that there's two really main rules that are associated with this. So this can be considered a downside, I think, for the families that we work with after we walk them through, these two rules and then sort of put them side by side with the benefits. They usually err on the side of putting the policy in place, but there are two main rules you have to be aware of. So the first is there's a diversification rule, which is really an IRS test that's done on a quarterly basis that is really more of a concentration test. So without getting into the weeds there, just as an example, no one asset can be more than 55% of the overall cash value of that policy. No two assets more than 70%, three more than 80, or four more than 90%. So it does require some level of diversification. Now, if you're going to have a diversified portfolio of investments, usually that's not a big issue because the investor is going to have that diversification anyway. right? But it is important to note that if you said, look, do I want to invest into one particular holding within that policy, that's not going to abide by those rules. So you do have to make sure that that is done. The other rule is called the investor control doctrine. So this is where more of our clients may have a little bit of an issue if they like to really have control over the investment decisions. That rule basically says that nobody that benefits directly from this life insurance policy can control on a granular basis what is bought and sold by that policy. So what that means is you could pick a manager of that policy. You can pick a sponsor of that policy in terms of say, hey, I like Peachtree offerings, or I like this asset class, but you can't say I would like to buy that fund or that specific asset. So depending on the client's level of comfort and what amount of control they like to have over those decisions, that could be a little bit of a downside. So it really just depends on what the client level of control, again, that they like to have over those decisions.
That makes sense. It seems like the trade-off is you're getting that compounding effect, and you're getting so much more capital, you're building up so much more net worth over time. So it seems like it's a fair trade-off as long as you have a really good, investment advisor that is helping you through this process.
Sure.
But really appreciate your time today, and to really just close this out. If people want to, reach out to you, I'm sure you're willing to talk to them more about how this works and help them through the process, or potentially answer any questions or direct them in the right place. Is that something you'd be willing to do, Michael?
Absolutely. Yeah, I'm happy to do that.
Perfect. How should people contact you? What's the best way? Is it just to go to your website, or what would you recommend?
You can reach us on our website. We're also on social media and LinkedIn. I have my own personal page, our firm, Beech Financial Group. We have our own page as well, so you can contact us through there. Our website address is www.cbfgllc.com, or you can call us on the phone, area code 856-988-8300.
And again, thank you. And just to close out the segment, with all the impact of higher interest rates, inflation, and everyone's trying to find ways to drive returns. I mean, tax efficiency is such a big part of it should be a big part of everyone's investment strategy to really have that compounding effect, as we've talked about today. And I think PPLI is something that anyone that's looking to allocate significant capital into private credit or into hedge funds should be absolutely looking at this, because this is something that just makes a lot of sense from a tax efficiency perspective. And, really appreciate everybody listening today, and we'll continue to have, future Peachtree Point of View podcasts pointing out different strategies to really maximize the returns on your portfolio. So Michael, again, thank you for joining us today, and we'll talk again soon. So thank you.
Thanks, Greg.
All right.
This material is being provided for informational or educational purposes only and does not take into account the investment objectives or financial situation of any client or prospective client. The information is not intended as an investment advice and is not a recommendation to buy, sell, or invest in any particular investment or market segment. Those seeking information regarding their particular investment needs should contact a financial professional. Beech Financial Group, our employees, or our clients may or may not be invested in any individual securities or market segments discussed in this material. The opinions expressed were current as of the date of posting, but are subject to change without notice due to market, political, or economic conditions. All investments involve risk, including loss of principal. Past performance is not a guarantee of future results. Securities and investment advisory services offered through Osaic Wealth Incorporated. Member FINRA, SIPC. Additional advisory services offered through Beech Financial Group, LLC, an SEC-registered investment advisor. Osaic Wealth is separately owned, and other entities and/or marketing names. Products or services referenced here are independent of Osaic Wealth.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.